Now, I said your breakers are your secondary points of interest, while your SC candles are your primary point of interest. Now, when your breakers gives you an entry, an immediate entry, maybe price does not want to go to your SC candle at that time, they want to just move quickly. They want to just move what quickly, they might give you an entry on your breaker. How do you take an entry? Your entry either at the top of the breaker or the 50% of the breaker stops above the what breaker. And your breaker is always in line with fair value gap. Now, when they give you that entry, if they are returning back to the origin, which is your sponsor candle, they use your breaker high or your breaker low as inducement of liquidity for your what sponsor candle. That's quite clear enough. I've gone about it 3 times, explanation, even more than 3. Now, your breakers, this last bearish candle, before we have this massive push up, is your what? Breaker. Why is it your bearish breaker? It was what was responsible for the break of this high. That was the last bullish order block we had before we price crashed down. That was what was responsible for the break of that high. So you see, break a high. Break a high, this candle was responsible for it. Breaking the high. Break a low, this bullish candle was responsible for taking out the low that broke the high. What is next thing? Around this area, we have our mitigation block. That is why price just came to that zone and mitigate. Is that price is using this as mitigation or using this as mitigation? This bearish candle broke that high. This bullish candle break the low. So this zone is your mitigation. So now a breaker carries a mitigation, but a mitigation does not carry a breaker. A breaker breaks a high, breaks a low, and carries a mitigation block inside. Breaks a high, break a low, and it carries a mitigation block inside. Breaker breaks a high, break a low. This is the low that broke the high. This bullish order block took out that low completely with this word impulsive move. Now, inside that zone is your mitigation block. A mitigation does not break a high, does not break a low. It's just what? A failed swing. Mr. Manda said other blocks are failed mitigations. You remember someone said that last week. I'm repeating it again. Mitigations are failed swings. So, Obina, finish what you're reading. The next person be session on that mentorship group. Look for breaker and mitigation PDF. It's a small picture. You have your breaker and your mitigation. I want you all to look for it and tag every other person. Go to the group. Somebody should look for it and tag the others quickly.
Okay, do I continue reading now?
Yes.
So after our liquidity void in premium, we have our bearish breaker. Then after bearish breaker, we have our bearish mitigation block. Then once price gets to discount, we'll be talking about price reading old lows. After reading old lows, it would form a rejection block. After a rejection block, it would form a bullish order block. After a bullish order block, it will leave a fair value gap behind and also a liquidity void. After which it would form a bullish breaker. Then to give us a bullish mitigation.
Pause. That is how price is delivered, Mr. Man and Mrs. Man in the Zoom. When you're reading the bullish, did you start from the bottom or you start from the up?
I started from the top. I started from the top. We started from premium.
You started from top.
Yes, it was premium.
When you're reading the bullish, did you start from the top or the bottom?
From the bottom. Because once I was done with the premium, I started from the bottom for the bullish.
Old lows. Now listen, your breakers and your mitigations are the last one because they help price, they resist price from moving against that direction. Now, this is, what did you read there? You go to the left-hand side, it said, expect price to reach for these levels in order of the appearance of the charts. Expect price to reach for these levels in order of appearance in the word charts. Using your PD arrays. Am I communicating?
This very chart doesn't have what you just said now.
It does have. It does have. Go to the one you pinned. The one you pinned. Okay, you're reading the one I tagged, right?
Yes, please. Okay,
go to the one you pinned.
Okay.
Old lows and high, rejection block, bullish order block, fair value gap, liquidity void, bullish breakers, and bullish mitigations. Your mitigations and your breakers are the last in the PDRs. They are the ones that comes up last because they resist and support price in moving in the direction. They resist and support price. So they are the ones that are formed. If these PDRs are not formed, they are not supporting you to go bullish or bearish. It's formed on lower time frame, 1 minute, 2 minutes, 3 minutes, 10 minutes, 10 hour, 5 hour, 6 hour, 10 hour, daily, weekly, monthly. This PDRA should support your momentum. If you are not seeing them forming like this, they are not supporting you. That means market is not ready, is not interested in going in your direction at that time. You wait. And then you're waiting for a 1 minute rejection block and a 1 minute breaker or a 1 minute liquidity void, just a 1 minute, anything to support your momentum. That one you pinned open and go back and look at it. The one Bali FS pinned, Bali FS. If you look at it, quick above quick nuggets.
Yes, okay.
Expect price to reach for these levels in the order of appearance. That was what you just read. It's the same thing. The order of appearance is the same thing it is here, and it's the same thing in the other picture. Are you all looking at the chart that I'm reading?
Yes, I'm looking at. So what's above quick nuggets?
Every other person, hold on, Obina. Are you guys seeing what I'm reading from the mentorship group?
Yes,
Yeah,
ma'am.
Good. Have you guys seen where I'm reading? Expect price to reach what Bali FS tagged?
Yeah.
Oh, you were saying something.
Expect price to...
Obina.
Yes, so I'm a bit confused because so where I can see quick nuggets, right? Then on top of quick nuggets is using PDRAs, which says
the third one now, expect price to reach in this already. The third one, I don't want to start reading everything. We read it already yesterday. Using PDRAs, identify your range high and low, identify your levels and institutional prices. I can't see the every other person can see.
Okay.
You cannot see the assignment. Don't stress me.
Expect price to reach for these levels in order of appearance on the charts.
What we just read, that's what you should expect price to reach for in these levels. Those are your PDRAs. There's nothing like higher highs and higher lows, market structure, other block. If these structures are not forming in this manner, am I communicating?
Yes.
Yes, yes, ma'am.
7 different pairs is the same thing. I just use USD Cardinal as a word case study. You see, when you rate that high, it did a rejection block, it did a fair value gap, liquidity void, breakers and mitigations came in. What support, what resist price? Was it not breaker that resist price first?
Yes, breaker blocks, yes.
Breaker resisted price from going up. Oh, price, hold on, want to go discounts. Resisted price and it fell. How many people? 100 and something. Later, they decided to go back to the old region to test that zone. And what did they do? They hunt the high, which is the rejection block, just to create a market maker. Now, what did I go to USD card? I was talking about now, they don't do a return to order block alone. They raid. That was why I brought out this chart. I was talking about mentorship on how you should continue studying because they changed their pattern. Before they just do break or failed swing, break of structure, return to the other block. They stopped. They do stop hunt, break of structure, return to the other block. Now they do stop hunt, break of structure, stop hunt again. That's their model they're doing right now. I've seen it happen many times. They just don't do return to other block. They will raid the other block that caused the break of structure, even if it's a daily, a 4-hour. They will raid it.
It's powerful. So I think I get it, guys. So she's trying to say that this flow, the way price is delivered goes in this arrangement. The highs, the bearish rejection block, the bearish. So if one cannot spot all these 1, 2, 3, 4, 5, 6, these 6 steps, then price is not ready to be delivered in that direction, which we are hoping for it to go. That makes.
Have you guys seen the breaker and mitigation structure? If you have seen it, tag me on it so that every other person can see it. Go and look for it because reference. Go and look for it on that group. I'm not going to look for it for you. So now you can see how they stop onto something, break of structure, left a missing data that price is not properly priced. So I was looking at price to reprice this zone because there's a fair value gap that was not properly priced. Instead, they did a consequent what? Encroachment. What is a consequent encroachment? When price fill a fair value gap, 50% of the fair value gap is consequent what? Encroachment. When price fill a fair value gap, 50% of it is called consequent encroachment. What is an entry drill? Institutional order, institutional EOFED, institutional order flow entry drill. EOFED.
Where price?
Institutional order flow entry drill. When price bounced off a fair value gap, it just bounced off the fair value gap. It didn't feel it. It didn't go to 50%. It just bounced off of it and reject and move. That's an EOFED. When price feel the fair value gap 50 pip, that's what? Consequent encroachment. When price feel the fair value gap completely, it has rebalanced and repriced that zone. When I hear the hear so.
Yes, ma'am.
Good. So I've explained fair value gap. Now, what is the fair value? Because our class for this week is liquidity void. So guys, outside this mentorship, continue studying. There are so many things I know I did not learn from. In fact, 80% of what I know is not from my mentorship that I went through. Was my mentor just put me on the right path. That's what I was saying, put me on the right path. So I was not running around. He gave me a solid ICT foundation, which I'm always grateful to him. Now, when people were asking me questions as at 1 year ago, I really didn't know much, but I had an idea. Now I put in lots of work, thousands of hours watching charts and studying price action. Most things I teach you is because I study price raw. Most things I teach you, I study price action raw. That's why I'm able to teach you what I teach you. So I study price and I have a first-hand view of price action. It's just like I should slap this Euro GBP for what this Euro GBP did to me. Now it's buying like crazy when I've been expecting this buy, bounced off the 50% daily fair value, daily order block. Exactly where I marked on my MT5. I was driving, I didn't enter. I didn't set a limit. So guys, what I'm doing for you is to put you on the right path, open your eyes, and when you continue to study and watch price action first class, you'll be fine. All right. Nobody will teach you everything you need to know in Forex. Nobody, no mentor, nobody, even Michael will not teach you. I've opened your eye to market maker, buy and sell model, a lot of things, structures and all that. Now, this week we are going into liquidity. Our class for this week is called liquidity. Now we have two types of liquidity. We have two types of liquidity. Right? We have two types of liquidity. Number one is internal range liquidity. This is the widest of all liquidity. It's the most complicated and the widest of all. Number two, we have external range liquidity. Right? We have two types of liquidity. We have internal range and we have what? External range. We have internal range and we have external range. Under internal range liquidity, which we are going to be taking today, we have fair value gap, liquidity voids. How of you saw the PDF on liquidity void on the group? Go and study it. Volume imbalances. How many of you saw the PDF?
I saw the PDF. I saw it.
I tagged all of you to study it today. I did tag you guys this morning. You guys didn't see it as take-home courses. The courses I tagged this morning.
I did see it. I saw it this morning.
All right. So the others did not see it. If you like, don't study it. You think I'll go and point it to you again? All the things I pinned today at the group, you didn't go through them back? Okay. So all the things I tagged this morning, you guys did not go through them. We have inducements of liquidity. Some of them will never do the right thing, and they'll be dropping nonsense setup on the group and disturbing people. They will not do assignment, they will not go through PDF, they will not go through file. Mentor, you are doing well, you are doing good setup. Oh, ICT Queen, I want to be like you. Can you put in the hours I put in to study? Or you think I'm just doing chat, I don't put in hours? I put in countless sleepless night hours, daytime. I study like like my life depends on this. Now I have dropped course. Now, how many one of you have gone through those PDF and just do a glance through and know the one you'll be studying and tag them according to the number of days? They will not do it. Inducement of liquidity. Under inducement of liquidity, we have hanging fruits, range structures, trendline liquidity. All of them, all those are inducement of liquidity. Under inducement of liquidity, we have range structures, right? We have trend line liquidity. We have hanging fruits. We have hanging fruits. We have range structures, trend line liquidity, hanging fruits. We have yeah, range structure, trend line liquidity, hanging fruits. That's under inducements. One place where I can copy it and put to the group. At the center of it all is you that I see. So today we are going to be taking internal range liquidity, guys. That's the biggest of all liquidity. We have external, like I said, we have external and we have internal range liquidity. So we're going to be taking what? External range, internal range liquidity today. Remember what I said? We have two types of liquidity. We have internal range liquidity and we have external range liquidity. I'm posting it to the group now, so you guys can. Have anyone seen the breaker and mitigation? Has anyone seen it? Am I muted? Okay, I'm not muted.
No, you're not.
No, you are not. We are looking for it.
I don't know. Continue looking for it. If you don't see it, that's how you people will miss that. So today we're doing internal range liquidity. Under internal range liquidity, we're doing internal range liquidity. We have liquidity voids. Under internal range liquidity, we have liquidity void. We have liquidity voids. We have fair value gap. We have volume imbalances. Okay, I think I've written that already before. I've done that already before. So under internal range liquidity, we have fair value gap, liquidity void, volume imbalances, inducement of liquidity. All of these are under internal range liquidity. Can you see what I wrote now? All these are inside internal range liquidity. Now we're going to be doing fair value gap, liquidity void, volume imbalances, and inducements of liquidity today. Now, what is a fair value gap? A fair value gap is as a result, it's caused as an imbalance, and it is caused as a result of when price leaves a particular zone quickly. When price leaves a particular zone quickly without pricing that zone properly. When price leave a particular zone quickly without pricing that zone properly, thus leaving a missing data. When price leaves a particular zone quickly as a result of a massive momentum, as a result of a massive momentum, when price leave a zone quickly without properly pricing that zone, a gap is formed, causing a missing data. That missing data is as a result of when two candles are trading into one, the high of the bottom candle and the low of the upper candle trading into one candle. That gap they left inside that one candle is a missing data and is a fair value gap. Two candles trading into one as a result of price leaving that zone quickly. Price failed to reprice or price that zone. Price failed to price that zone properly. So price comes back to that area, repricing that area to be fair enough. That's why I call it fair value gap. That gap they left is a missing data. So it's usually filled with a wick. It's usually filled with a wick, not body candle. It's usually filled with a wick. In the future, sometimes fair value gap can act as what? Other block. Price can use an old fair value gap as a zone of rejection block. A fair value gap that has already been filled with body candle or wick can be used in future as a zone that price wants to react from. reject from. Am I communicating? Now we have three ways at which price fills a fair value gap. There's a three ways price fills a fair value gap. You see that price fill the fair value gap completely, thus pricing that zone properly. There are three ways price fills a fair value gap. Remember I said fair value gap is filled with a weak rejection, weak. Now the three ways price fills a fair value gap is either price fill that fair value gap completely. You see that price fill that fair value gap what? Completely, thus pricing that zone and is fair enough for the price to go to its direction. Or price bounce off the fair value gap. Can you guys hear me?
Yes, I can hear you.
Guys,
Yes,
was
ma'am.
my
Yes, ma'am. We can hear you.
was my
It's just
voice
something a little
breaking?
bit. Yes, ma'am. Just kind of, just stuttering a little bit.
Okay, but it's better, right?
Yes, ma'am.
Yeah.
Now, three ways which fair value gap is filled. When price completely fill the fair value gap, it prices that zone completely. It's properly priced and price can go to its direction. When price fill the fair value gap 50%, consequent encroachment. When price fill the fair value gap 50%, consequent encroachment. Or when price bounce off the fair value gap without filling it, you just tap on it and bounce off it. Is an entry drill, institutional order flow entry drill, IO Fed. I've named the three ways at which a fair value gap is filled: complete fill, properly repricing that zone. You see how price fill that fair value gap right here. You properly reprice the zone, fair enough for price to go to its direction, or you can bounce off the fair value gap. I think I posted something like that on Euro USD weeks ago when it bounced off the daily, causing an O-Fed and it fell. The price bounced off a daily. So sometimes don't expect the fair value gap to be completely filled. Price might not be interested in filling it. It does that especially on intraday. It does that most especially on intraday. So price might just bounce off a fair value gap and not fill it completely. Now, this is an example. This fair value gap was completely filled. Now, let me show you an example of when price bounced off a fair value gap. I usually see them on the daily 15 minutes.
Sorry, Queen. We can't really hear you.
Yeah, no, she's on mute. Peter, she's on mute. Okay.
Now,
This is
guys,
talking.
look at this fair value gap. I just came back. I wasn't talking. Can you guys hear me?
Yes, I can hear you.
Yes, I can hear you.
This fair value gap that is here. Typical example of, who can tell me what is it? I just thought it now. Who can tell me what price did here? Because it's not for me to be teaching, you just be listening and you don't have anything.
Consequent encroachment, because it got to 50% of the fair value gap.
Now you see how price rejected off the same fair value gap. Can you see that?
Yes.
An old fair value gap that has already been used. When price used that fair value gap, it bounced off the 50% consequent encroachment and did over what 200 and something pip. It came back to that fair value gap again. You see how we use it as a rejection? Bounced off an old fair value gap. That's what I'm telling you. That's what I was trying to explain to you. One way, it filled it completely. Second way, 50% consequent encroachment. Third way, it bounced off it higher fed. I usually get the, this is where I'm looking to buy USD card, this zone. Okay, let me look for another. Now, can you see what price did here? Rate this high, which is stop hunt, right?
Yes, ma'am.
And caused a massive break of structure to the downside. This is the break of structure. Look at it. And see, we have this long rejection, which I know price is going to come back to it very soon. That's a long rejection from price. In one day, see how price bounce off. Now, you see price caused a break of structure after the stop hunt. Now, what I want you to see is that normally, you want to see price react from this zone. This rejection, this is a rejection block. But they might likely now raid this high before they give any sell. That was exactly what they did on USD card. This high took out all this liquidity. Are you seeing that this high was raided by this high? Okay. This is part of liquidity. You see, I rate those high, then fell. Now we are returning. Normally, you want to sell. I was looking to sell at the 12.5 fair value gap. But what's happening? They are not giving an entry on that zone. They might reverse on the 50% or sweep that high, because this is a higher time frame zone. They might sweep this high just to clear this liquidity right here. Now, what's our next thing? I've explained fair value gap. We're going to go into what? Liquidity vol.